the more time I spend in investing, the more sort of it crystallizes that people are just everything, no matter what stage of business. Obviously, the earlier you go, the more important each individual person at a company is. But at any stage, a company at the end of the day is just a collection of the sum of its people. And so some of the really fun moments is like when a portfolio company lands this A plus rock star hire, like they just landed the best VP sales or CRO in the industry, or like a game changing CMO or president or COO. And that really does, it's amazing how one hire can change the trajectory of a company.
Hey everyone, today we're joined by Karthik Ramakrishnan, who is a partner at IVP, a venture firm that leads early and growth stage rounds in startups across B2B software, consumer, fintech, and digital tech. IVP has backed companies like Twitter, Snap, Discord, Datadog, CrowdStrike, UiPath, and Dropbox. I'm sure you've heard of some of those. Some companies that Karthik works with include DeepL, Dream Games, Niantic, CrowdStrike, Attentive, and Numeric. And in his free time, Karthik is a huge sports fan, including the Brooklyn Nets and the New York Giants. He loves to play racket sports and enjoys spending time with his wife. And he is recently a first-time dad. Welcome to the pod, Karthik.
Thanks for having me, guys.
Yeah. Today we really just wanted to chat with you a little bit about how you got started in the investing world and just like hear some of your deeper insights, some trends you've been seeing, and just hear a little bit more about how you think. So maybe like just to kick things off, we could start with a little bit of an origin story, right? Like how did you get to where you are today and where did all of this start?
Yeah, I think a lot of probably comes back to the sort of quintessential immigrant sort of family story. But born in India, but my parents and I came here when I was like 4 years old, so consider myself American, but with those roots. But I grew up on the East Coast in New Jersey, and then went to school in New York, and sort of grew up as a lifelong New Yorker. Spent 4 years at NYU. Thought I would be in New York for life. Never considered anywhere else. But along the way in college, I fell in love with technology and startups, and had one. I was in the business school, so I was went down the finance rabbit hole. My first job out of school was investment banking, and as on campus recruiting goes, you have a bunch of different interviews and hope you get one, maybe a couple job offers. Had 20 something interviews in New York, one interview in San Francisco, a job in San Francisco, and I didn't really think about it, but I ended up doing my summer internship there. Then I moved there right after college, and did a couple years of tech investment banking, and it was a really fun experience. We worked with sort of really large public software companies, but we also got to work with smaller startups who were sort of considering different routes, whether it was raising capital or selling the business by an acquisition, things like that. And I find myself drawing myself much more to the startup end of the spectrum versus the large company end of the spectrum, and working with those founders, those teams, those boards of directors. And yeah, worked on some deals, met with a bunch of other companies where we didn't end up doing a deal, but we got to spend a lot of time with those founders and teams. And that was a really fun part of the job for me. And then ending up at venture, it was a little bit of a natural transition just because, we had the chance to meet with a bunch of different sort of investors, venture firms who are on the boards of these companies. And so I met with a number of different firms that way, including IVP. And venture just felt like the right next step. I considered different things within finance, private equity, hedge funds, things like that. But those were all with obviously later stage businesses. And I wanted to work closely with startups. And IVP specifically, we're sort of what I call an early growth venture firm. So, we do mostly sort of Series B and C rounds. So we're not investing sort of like pre-product. We're not doing seed investing, things like that. And I do think there's a different skill set required for that. And so the place where I'm at now, I think marries some of my sort of finance and quantitative background along with love for startups and early stage investing. And yeah, it's been almost 6 years now doing that, which is crazy. Time flies.
Could you tell us a little bit about iBanking versus VC? Like, is there a difference that's crystallized in their models, or is it just what they focus on, like late stage, early stage? Can you dive into that a little?
Very different. I think the vast majority of people don't want to do investment banking for more than 2 years. I didn't last longer than that. The average tenure in VC is much longer. Banking, it was like a really I call it just a boot camp. You're sort of fresh out of college. You're working your tail off. You're working with hopefully a really great team and mentors around you. And you just learn both finance and honestly just how to be a professional. and it was just a great experience. But yeah, the jobs are, I think, fundamentally different. I think as an investment banker is essentially, if you boil it down, sort of a consigliere, like a highly trusted third party that knows all the right people in your industry, and is the person you call when you have to make one of the biggest decisions as an entrepreneur, whether that's selling your company or going public, or merging with another company. And so versus investing, the weird part of the job is you have to say no 95% of the time. You look at thousands of opportunities every year, and we as a firm, for example, we only invest in maybe 12, 15 new companies a year, and so we end up having to say no to the vast majority of them, which is hard, and it's not the most fun part of the job. Whereas on the banking side is you want to do as much deal volume as possible, because that's how you get paid, and after you sort of do the deal, your relationship with the company ends. Versus in investing, like, that's really the beginning of the relationship. When we're investing in a Series B or C round, that means we're signing up for a 5, 7, 10, 15-year relationship with every single new portfolio company. And we have to be there through all the good moments, and that's fun, but also no startup is constantly up into the right journey. Everyone has really tough moments, ship moments, where things are looking really bad, and you sign up for those too. Yeah, I think it's super different, but grateful for my time in banking.
Can you share some examples without naming names of, like, what are the, like, oh my God, this is an amazing moment versus, like, oh shit, this is a terrible moment, or like a low moment?
Yeah. The more time I spend investing, the more sort of it crystallizes that people are just everything, no matter what stage of business. Obviously, the earlier you go, the more important each individual person at a company is. But at any stage, a company at the end of the day is just a collection of the sum of its people. And so some of the really fun moments is like when a portfolio company lands this A+ rock star hire, like they just landed the best VP sales or CRO in the industry, or like a game-changing CMO or president or COO, and that really does. It's amazing how one hire can change the trajectory of a company over the course of like the next 3 to 5 years. And so, like, when you get that call from an entrepreneur saying, "I've closed the offer, this person is joining," like, that's amazing. On the commercial side, obviously, it's like, company knocks it out of the park, like beats their financial plan for the year, or like lands an amazing Fortune 500 customer. Those can be, game changing for the business. Obviously, future fundraising rounds are great too. At the point at which we invest, we're most often not the last time a company takes capital. They're usually raising at least one, if not multiple rounds of capital after we come in. But, sort of fundraising milestones are less valuable for me because they're not operational. I mean, it's important, and obviously companies need capital to continue their journey, but the other things I talk about matter a lot. I mean, the ship moments, you just, those are infinite, and they come in every flavor. Company servers could go down and they can accept revenue from their customers. Their users are extremely mad the product isn't working, and overnight you could lose the trust of your user base, or you could lose 10-20% of your revenue overnight. And that's definitely happened both in and outside of our portfolio. So that's really scary. Or a major customer churns. Or on the flip side, one of the founders of the businesses leaves after they've spent 5-7 years into a company, and they've hired out half of the team. And so, yeah, there's a lot of things that happen, but I think you sign up for both ends of the spectrum.
So I'm curious, like, let's say I'm coming to pitch you a company. I walk up to you and I'm like, okay, Karthik, I got this great company I'm growing. We do XYZ business in with Y number of people. I'm trying to get to, what metrics are you asking me for, where you're trying to get a sense for how am I doing? Like, what are those key things that you're trying to gauge or that help you to judge, is this a company you're interested in investing in or continuing the conversation in?
Yeah. So we invest sort of, post product market fit. So the companies that we invest in generally do have customers, paying customers, revenue, things like that. And so for a software company, there is some element of a spreadsheet analysis you can do. You look at the revenue, you look at the cohort retention of their customers, you look at how much customers are expanding, how much customers are churning, all those things. And we, of course, do that for every company we take seriously. But my sort of North Star is I'm very product and customer oriented. And I think product metrics are often a leading indicator of sort of financial metrics, revenue, things like that. And so I really want to understand sort of who a product's like real ICP, ideal customer profile is, and then how much and how frequently are those customers actually using your product, and sort of how deeply embedded is it into their workflow. The best products are obviously being used every single day, if not every single week, and they have really high love, and they grow organically within an organization. I know Vivek, specifically, you worked at some companies that have exhibited this, right? They start at a handful of users, and they just grow and grow within an organization until they have a wall-to-wall deployment. So that's something I'm looking for. And then we obviously want to do our homework, and for any company we're really interested in, we end up talking to many of their customers, and customer feedback is always the best because it's unvarnished, it's unbiased. They have no reason to lie to us, and so they're honest about it. And we really want to hear, like, is this a core part of your workflow? 5 years from now, are you going to be using this product? We're looking for signs of real durability, longevity, things like that. And so that stuff is really important to me. And then obviously the founder and the team, how passionate they are about what they're doing. Do they have some sort of founding, story, reason to start the business? Where are they in their journey? And so oftentimes those are much more important than some of the quantitative diligence we're doing.
And I know it looks like, just within your firm, you do investments across consumer, B2B, software, fintech, pretty much runs the gamut in terms of the types of companies. Would you say, what are some of the nuances there, right? Like for a consumer company, you could talk to customers, for a B2B company, you could talk to customers, but like, how does it differ when you're looking at different companies, or is it roughly similar for all the different types?
Yeah. So we at IVP, we focus on technology broadly. So we do a lot of B2B enterprise software, both application layer and infrastructure layer. We've done a lot of consumer over the years, fintech, digital health, and different team members have different specializations. I spend most of my time in sort of application layer software, consumer, and then some infrastructure. But at the end of the day, I think we're just trying to find out the true voice of the customer. And yes, it's a little bit different with B2B companies. There's obviously a finite number of customers you can talk to, and you can get your hands on them. So we'd love to speaking to at least 10 to 20 customers, if not more, to really understand how they're using the product. And we want to get a different flavor profile, right? We want to talk to their larger customers, but we also want to talk to either smaller customers or people who have just onboarded the product, because these companies are shipping products so quickly that the product today looked very different than 6 or 12 months ago. So we want people who have experienced it and played with the product and onboarded at different points in time. For consumer businesses, there is actually a lot of interesting third-party data you can look at, and we track all of that. If they have a mobile app, there's tons of rich data on things like mobile app retention, usage, time spent, things like that. We have an in-house sort of data system, if you will, that tracks things like that on which consumer products are performing the best, which are sort of growing the most quickly over different periods of time. But we also definitely want to talk to actual customers as well. And if those are individuals, those are great. And the goal is, to ideally talk to hundreds of people and again, get a different flavor profile and like a wide range of different people. But, the North Stars are similar, right? It's usage, frequency, and then organic growth, whether that's number of people in an organization, number of use cases or tasks that you're using this product for, some heuristic of that.
For you, how do you judge, like in the VC world, I think there's this need for binary outcomes. Like you either have like 100x or whatever multiple on your investment, or, you're kind of okay with it maybe going to zero as long as you have a few of those 100xers. So first of all, tell me if that's wrong. And then I guess secondarily, is it weird to think of businesses as like, I almost want to bet on this for the 5% outcome, and I'm trying to find the businesses that have that particular ability to potentially be massive, even if there's a large chance that they're worth nothing, rather than investing in these middle ground companies that might be just, I know they're a good business, but they're not going to do 100x.
Yeah, I think the point you make is fair. I think, there's plenty of research out there that shows that VC does follow sort of the Pareto principle. A small minority of investments drive the majority of returns. That's probably true across most venture firms' portfolio. The way that manifests in sort of our day job is we're very much trying to understand. We very much want to answer the question, like, what could go right? It's infinitely easier to ask what can go wrong. And our job is to say no to the vast majority of things, but it is to dream the really big picture. If you look at, the majority of public internet and software companies today, 10, 15 years ago, they looked like very different products, and very few people would have guessed how big they would become. And that's what our job is. And so it is, it's using the information today, but also putting your own cap on. It's taking what the founder is telling you, and to imagine like 10 years from now, what could this be? Like, could this be $1 billion a year in revenue? Could this product that's doing 10 million a year in revenue today, could that be $1 billion in a decade from now? And so that's what we're sort of trying to understand. Like, does this product have platform potential? It's not today, but if they build out the next 5, 7, 10 features, does it become a platform? Does it grow user base? Like, is there a ton of international expansion? And so that's what we're trying to answer. We get it wrong all the time. We get it right a few times. And it's the amount, but also the magnitude of how much we get it right that answers the question. But that's also sort of part of our specific model of, we only make 12 to 15 new investments a year. And we want to make that commitment to companies. Like, obviously not every company ends up having the same return profile, but we want to make sure that we are good partners to every company throughout their entire journey, regardless of what the end outcome looks like. And if you call on any entrepreneur we've backed, whether it's the companies that have ended up delivering the best returns for us, or it's on the other end, the companies that maybe haven't worked out well, I'd hope that both of those sets of entrepreneurs will have the same feedback about us. And that's really important to us. And that's why that's sort of, we've obviously, our firm has been around a long time, and venture as an asset class has changed a lot, particularly in the last 5 to 10 years. And, some firms have dramatically sped up the pace and quantity of their capital deployment. We haven't done that because we want to make that commitment.
Yeah, I imagine that'd be like incredibly important to the future in people that you're going to invest into, to have that reputation of, okay, we're going to support the company regardless of if they're going to some troughs. We're going to be there long term, because they might pick back up and might become a huge company after going through, like you talked about this earlier, there's inevitably going to be some slips in the journey. And if you abandon your founders in the middle of those slips, you both lose reputation, but also the ability to kind of pick back up when they can grow again.
Totally. Reputation is one of the very few things that we have, and it's really hard to build and obviously very easy to lose.
Well, to switch gears a little bit, recently we heard, and Karthik, I know you're not the biggest self-promoter out there, but you did make the Forbes list for 30 under 30. I'd be curious, what led to that? Like, why do you think that happened, and how did it happen?
Thanks. You've probably seen the anti 30 under 30 list, or the 30 under 30 list to jail pipeline. So I don't know the quality of the I'll take it, but
no, for background to anyone listening here, like when it happened, like I think I texted Karthik. I heard about it through family and friends, and I texted him, and he was very like, he's not a self-promotional guy, but I'm just curious what goes into that, and how did it even happen, and how did you hear about it, and how does it work?
Yeah, I mean, I think like my personal sort of motivation is just to do the best you can individually, and then let the cards speak for themselves. So yeah, I mean, it's been a great run at IVP, but just spending as much of my energy as possible, helping the portfolio companies I already work with, and then spending a lot of time and energy trying to find the next breakthrough set of companies every year. And it's a really fun and a rewarding job, and we have an amazing team, and we work super, super collaboratively together. And yeah, I guess people saw some value in either what I've done or some of the companies I've backed. And other people from IVP have won the award in the past, and they're much more deserving, and other people will win it in the future. So yeah.
Viv's, Karthik's just focused on his statistical chance of going to jail has increased since getting this award. And there's really no way around that now.
I think that's, I think the numbers speak for themselves. So I'll be careful.
What do they do though? Do they call you, like, they sort of call you out of the blue? Is it almost like winning a Nobel Prize or something where you like wake up at 4 a.m. and they're like, hey, we want to put you on this list? Or is it an interview process that you apply to? Or how does it work?
From what I remember, there's a couple of steps. There is an intermediate step where they filter down their sort of pool to some number of qualified candidates, and then they ask you to write some sort of self-reflection essay and ask about your contributions sort of in your professional career in the firm you worked at. You don't actually know you've made the list until everyone else does. And so I woke up in the morning, got published, like I did not know I was going to be on it. And I woke up and I was living in San Francisco at the time. So, and they, I think, they publish it at 6 or 7 a.m. Eastern or whatever. And so I woke up to like 100 texts, calls, like congratulations. I had no idea what was happening. And then I had to, someone linked the article and I saw it. And so, that was funny and eventful morning.
Wow.
What did your, this is a uniquely like immigrant thing to ask, but like, what did your parents say?
My parents and my yes, I think really the four people I wanted to show this to were my parents and my in-laws. Vivek, you know how Indian parents are, so I think they were very thrilled, rewarded. Hopefully, that has validated my decision not to get a master's degree, which I don't know if my parents have forgiven me still, but I hope this makes up for it.
They're going to ask you immediately, like, wait, are you going to be on the 35 under 35 list now?
That's true. I've set myself up for failure.
Don't go to jail. Like, it's like always it's like, good job, but,
Yeah.
So what, can I go back, Vivs, to the previous part of the conversation?
Yeah.
I'm curious. So like in trying to bet on things that are going to become potentially really big, do you have certain trends or spaces you're really excited about investing in right now that you think are gonna match up with sort of technology waves that you see coming? And yeah, after talking to all these hundreds of companies, do you see trends in the data on what you think is going to get big now?
Yeah, I mean, there's obviously AI is the talk of everyone. What I've been spending more time on recently is sort of vertical specific applications of AI, which I think are really fascinating. And there's like, you know, the sort of beauty of a traditional vertical software is these are just what might seem like small markets are actually massive end markets, but at the same time that face much less sort of competition from the horizontal players. And I think with AI that matters even more is because we've seen the incumbents, obviously Microsoft, OpenAI, Google, et cetera, move so much faster. The incumbents in this wave compared to mobile or internet are moving so much faster and are so much better equipped than before that like competition is very much, I'd say is more of a threat now to startups than it was in previous times. But in sort of like vertical specific applications, you most likely won't have to wake up every week worried that OpenAI or Anthropic or Google will release something that'll kill your business overnight. And I've always enjoyed spending time with vertical software founders because most often they've experienced a very deep pain point in this industry before, and they've started this company for a very visceral reason, whether it's healthcare or insurance or financial services. They've probably either worked in that industry prior or they've experienced a pain point and they want to reinvent the industry for the better, and so they know it in and out. They know their customers to the core and they know exactly what they're building, and with AI now, like there is an opportunity not just to build like a 10 to 20% better vertical specific product, but like a 50%, a 2x better product, and like we're just seeing so much innovation in so many different areas. Healthcare is an obviously big one. We made some investments there. Insurance, financial services, like massive, right? Like you just think about like how much the volume of money that's like underwritten every year based on imperfect data, and data will never be perfect. But now compared to even 3 years ago, there's so much more valuable data that you can use to make some of these decisions. And then like in areas, probably people think less about, like for example like home services. You think about like HVAC, roofing, pool repair, like all these things. Like these are massive industries that have historically operated very much offline because they're door to door. They happen in the community, but there's a lot of data that's not being captured that will be captured, and that will make hopefully transaction costs lower for the end consumer, but also will empower these SMBs sort of in the community to be better as well. So yeah, super excited about many different verticals, and there's a lot going on. That's just one area. In consumer technology, gaming is an area I've sort of always spent time on, and I am a personal gamer, a very bad one, but it's also an area at IVP that I spend a lot of time on. And there is a question of mobile gaming has had an amazing rise in the past sort of 10 years since the advent of the iPhone, but it's been a tough past couple of years for mobile, especially sort of post-COVID, dealing with the hangover effects of everyone sitting at home having nothing to do, to reverting back to sort of what the world was like before. And I think there is a real and fair question of is the peak of mobile gaming over? I don't have a crystal ball to that, but what is next is super interesting. Like I think gaming, I'm super bullish on the secular trends of gaming. Like you see how the young generations interact with each other. You look at just like what people are doing. Like people are going on Roblox not to play, but to hang out with their friends, to do homework with their friends, to just chit chat with their friends. These gaming platforms are not really gaming anymore. Like they're a place for community, especially for the younger generations. And so if you roll that forward 10, 20 years, I think that's only going to accelerate. So I think there will be some massive consumer platforms that we've built that look like gaming companies, but aren't really. There's something much broader than that.
Have you seen that trend in any of your portfolio companies already today? Because I know you've personally made some investments in gaming companies, and then also the portfolio has gaming and gaming adjacent companies like Discord. So how does that look in the companies that you all sit on the boards of today?
Yeah, we've been super privileged to invest in some amazing gaming companies over the years, starting with Zynga and Moko back 10, 15 years ago, Supercell in 2013, and then more recently, you mentioned Discord, Niantic, the makers of Pokemon Go, Dream Games, So Rare, and a couple of others. Yeah, I mean, Discord's like a great example, right? Like gaming was sort of very much the core user base and use case, but if you look across their massive scale today, they have so many different types of communities on the platform, and it seems like with every new sort of social or consumer trend, Discord is one of the platforms underpinning that. It was crypto, obviously. Almost every major community was on Discord. Now with AI, this is how a lot of AI developers, are communicating their new products to. They're using Discord, and all the sort of early product testing, things like that, are happening in Discord communities, and I expect that to continue with whatever the trends will be, 2, 3, 5 years from now. So yeah, Discord's sort of like a wonderful enablement layer for that.
Could I pause you on Discord for a second? Because I'm not at all familiar with Discord. Like, what makes it uniquely good for what it's used for? And what draws people to using Discord?
Yeah, I think, like, if you just play around with the product, it has like a different ethos than your other communication apps. A lot of people find it hard to use, and I still do too. But I think it always just resonated first with gamers in a way that gave them real credibility, and they've always been really good about encouraging personalization of the user base. And so if you go on today, you can get sort of custom skins, you can set up your own custom server, and have specific ways you want to run that, things like that. So they've always given a lot of agency to their users, to their moderators, in a way that I think uh, that's gained trust and goodwill. And they sort of continue that beyond gaming. But it's a hard to answer question with some of these like consumer platforms, like why they're so
Yeah.
dominant, or why so they're big. It is a bit of a chicken and egg thing too. Like, network effects are real.
Yeah, and Karthik, keep me honest, and maybe Arv to explain it a little bit further, because I'm sure you have the question. A lot of people out there have the question, like, what is it? Like, correct me if I'm wrong here, but Discord is almost like, I'm sure you're part of a few like community groups, like on Slack, for example. It's a lot like that, but it's a lot more customizable and puts more power in the hands of the people who are administering it. And it's actually a lot more like it has a really strong API and allows you to do really cool automations and stuff like that that make it really um, good for community building. Um, is that roughly there?
Yeah, yeah, that's right.
Yeah.
Like, we would have a Discord for this podcast
Yeah.
eventually, and we would solicit ideas from people, or we could build the product better as a community through Discord. That would be kind of a use case.
Yeah, and like, for
Totally,
example, like
community building.
Okay.
almost every subreddit, like a lot of subreddits have their own Discord, because like Reddit's a great place to make a post and get people to comment and upvote and all that stuff. But it's not like a good chat. It has a chat capability nowadays, but back in the day, Reddit didn't really have chat and like the ability to foster community in that like real time way. And so like a lot of the Reddit subreddits that I'm a part of will have their own Discord community where it'll link to a Discord server where you can join and have conversations with people in real time.
Yeah, I have a general question about community online, or like a related question, which I think Facebook got really big early on because there was this community trust element that, like, it was everyone was in the college campus community and it was this protected group. Whereas, MySpace, Friendster, all these other companies had pretty open sign-in abilities. And so you could kind of go in as anyone, you kind of didn't know exactly what the network looked like. So there was this extremely high trust network. It feels like to me, with a lot of generative AI video like being created that's new, this is going to get worse over time, but there's going to be this deep desire for like trust and verification of an online network in order to really feel like you can engage with it. I'm curious if you're seeing the current big players maintaining their lead in that way in those spaces, even though they've gotten really big, or is size in a way antithetical to maintaining that sort of trust in the community, and you're seeing smaller players in that community being able to thrive because they're like more niche, they're more family group or something like very tight? How do you think about, is that dynamic playing out at all?
Yeah, I fully agree that I think the internet is just getting more and more sort of disintermediated, and trust and and verification are just going to be more and more important, especially like, I personally believe, there's a lot of hype around AI agents and things like that. I do think, I believe that, AI agents will get to a point where they can truly autonomously complete multi-step difficult tasks. The question is on what time horizon. I don't know the answer to that. But in a world where that happens, like there's just going to be more and more traffic on the internet, and more, just a higher volume of activity on all these platforms is going to be not bots in the classic bad sense, but like AI bots, doing tasks versus individual people. I do think there's going to be a lot of weird cases where like AI agents have to be interacting with real people and like talking to each other in like a way that humans talk to each other. And there's a question of, how should we be treating that? How should we display who's human, who's not? There are, I think, a really interesting sort of wave of newer companies working on that infrastructure layer of like authentication, enabling AI agents to like, actually perform actions across different places on the internet, but also establishing like who's human, who's an agent. So I think that there is a lot of like interesting activity going on there, and there probably will be a big company there. And I think for like the large incumbent social platforms today, it's going to be probably hard to re-architect their product, just given the massive scale of the user base today, in a way when things dramatically change the next few years. So I do think it'll be a hindrance to them. And then, yes, there's been a change in administration, but I don't think any of the big incumbents can make a big acquisition in the space going forward. I just think it's kind of bipartisan now, that big tech has gotten too big, and so they can't use acquisitions as a way to innovate.
Do you think that change in administration will open things up more than they have been, or do you think that it's going to remain roughly similar because there's a equal level of disdain?
I think the change in administration is a moderate tailwind for M&A in general. I think for big tech specifically, Facebook, Amazon, Microsoft of the world, FANG, Mag7, those companies, I think they're probably permanently handicapped from making big strategic moves. I think that is like bipartisan now. It seems like, both sides of the aisle agree on that issue. But in general, I think, the next 4 years, and if you look at the actions of the FTC and the executive branch, I think it will be more favorable for M&A in general. And then there's a big question of the IPO markets, and
what's your opinion on it, given where you sit? Because on the one hand, if the big incumbents are handicapped in some way, there's room for startups. On the other hand, companies that are looking for exits to these big companies with large piles of capital aren't able to be as successful getting an exit. So are you neutral? Are you pro? Are you anti? Like, how do you feel about it?
Yeah, I mean, antitrust is real, and it has a long history in our country, and I think it should continue to have that. And we don't want monopolies that end up harming end consumers. So I think like that, sort of antitrust should always exist. I think we have to have very clear reason on why and when we would block or prevent an acquisition from happening. And there's been I think it's, my opinion is that there have been a few head scratchers in the past few years on some acquisitions that have gone canceled or blocked. And I do think that has a chilling effect on the tech industry as a whole, because like you said, only a small fraction of startups get to a scale where they can, enter the public markets. The vast majority of exits end up in acquisitions. And we want an economy where entrepreneurs and management teams, and then obviously the employees at all these startups, to eventually have a way to realize their hard work. And so, yeah, overall, I think it's chilling.
Would you be willing to share which one were head scratchers for you?
Off the top of my head, like Amazon not being able to buy Roomba, the robot cleaner in the house. Like, I don't know. Look, I am no expert on Roomba as a business, so people should correct me if I'm wrong. But after the acquisition got blocked, the company did a massive round of layoffs. They were clearly not in the best position. And so, would you rather block an acquisition and then have that company end up faring worse off, or would you rather have that company get acquired and hopefully do well within its acquirer? I think that's a fair question.
I mean, to me, one question I think that's coming up is around exit valuation required, though. For me, is like, it feels like the bar to going public has just gotten higher and higher internally for companies. Like, companies used to go public with 500 million billion-dollar valuations. I think even like as recently as 25 years ago, pre, internet crash.
Yeah,
It
and
seems like
there was that big SPAC thing where like there were companies like even in some cases like pre-product even.
yeah, that was more recent, right? Like 2020-ish, right? And then that seems like that's completely disappeared. So why has the bar shifted so dramatically? People don't seem to want to go to the public markets, even with pretty significant and high revenue, high valuations.
Yeah, I think the perceived bar to go public is higher, absolutely, now than 5 or 10 years ago. For the current, just given how the sort of cycle of venture in the past few years, I forget the exact number. There's something like 1,000 or more, unicorns, like technology companies valued at over $1 billion. A lot of those companies, during the past few years, raised money at valuations well ahead of their fundamentals. And so I think one thing playing out right now is that there's a lot of companies that have raised money 1, 2, 3, maybe even 4 years ago that, despite a couple of years of execution, still haven't grown into their last round valuation. And the conceptual um, idea of going public at a lower valuation than your sort of last private mark is painful to founders. And some of them do feel like it has a deleterious effect on their employees, morale, sort of just public sentiment on their company. I think that's overblown. A little bit of that is true, but I think at the end of the day, private valuations are at a mark at a point in time. They are by no means accurate. They don't change unless a new evaluation happens, things like that. And so I think there's a lot of companies that feel like they would, if they went public right now, they would not have a successful sort of first year or two in the public markets, just given how much they've raised prior, given sort of where their business is at now. But there's no reason why I think probably just based on conversations, like it feels like companies think they need 500 million or more of revenue to go public. I don't think there's any necessarily reason why a company with 200 million of revenue couldn't go public. And my sense is we probably will see a couple of those that do that in the next 2 years, and then those will be sort of the bellwether for other companies to do the same. If they end up having successful listings, then I think we'll see more. If not, then I think companies will wait. But and then there's obviously the requirements of going public. It is getting more and more expensive in terms of compliance, regulatory costs, and if you're a private company founder, you don't have to do earnings calls every quarter. You're not judged by every percentage point of revenue and growth you're able to hit. So, what a founder wants also dictates a lot of that.
I find it pretty ridiculous that it's hard to go public when like initial coin offerings can be made of like random things at random times with no regulatory oversight. So
that's partly the reason why those offerings became a thing, probably because like it's quite a high bar you have to hit to go, or at least the perceived, like
sure, yeah. There's like a way around it through these ICOs, but it feels like they're like a separate mark. I mean, this is more just like a mental comment for me, but it feels like these things are too different, and they shouldn't be that different. But then I'm also curious: does it make your job way harder as a VC if these exits are just delayed and delayed? Don't you have more of like a 10-year time horizon on the fund return? And if that's the case, like how are you managing the delayed? The shift both in M&A being slower and in IPOs not occurring at the rate they used to.
Yeah, companies are taking longer to go public. If we just look at sort of, the 2021 crop of IPOs and the time, and look at the times they were founded, it's very much a sizable increase compared to prior years. So I think that is true. At the end of the day, I think our job is to find the sort of generational companies of every sort of vintage and cycle. And if we're able to partner with the best companies, then we're able to deliver great returns to our LPs. And that's the name of the job. It's really those game-changing companies that really matter. And so that's kind of our singular focus.
Yeah. And I guess putting your banking hat on a little bit here, what is sort of as a banker, like what makes a company, is it really true that like anyone that walks in the door that wants to do an IPO, you'd be like, okay, let's do it and figure it out? Or is there like some sort of a disqualification process?
In some ways, you are motivated to do the deal because you're paid on a successful listing. So there is that element of it. But we talked about reputation before. As a banker, you have a reputation too, and you want to be associated with companies that have had successful listings. And so we speak with amazing banking teams all the time. And they're very much, in some ways, for the later stage businesses that are close to going public, like they look at a lot of the same metrics we do, sort of, growth rate, sort of efficiency metrics at scale. Where does it sort of benchmark to both the public and private software or internet or technology universe, sort of qualitatively, like where in the product journey are you? Like, are you still only have one product, or have you established sort of a demonstrated evidence of building a platform over time? Because in the public markets, that's very, very important, because getting to $1 billion of revenue or more, you almost always need to be a platform and have, 5, 6, 10, whatever it is, successful different products that are selling into your customer base. And so I think those are a lot of things like banking teams are looking for. And, that's what they're advising their companies. And, if they don't think a company's going to have a successful listing, that affects them too. So, I think that counteracts it.
Now, switching back a little bit to VC, one question I definitely wanted to ask you before we'd close is sort of like in your day-to-day job, like one thing that we talked about at the top of this call was you say no to thousands of companies, you say yes to a handful. Like that means you're having lots of meetings. Like, how is that happening? How are you getting these companies to reach out? Is it mostly just reputation based and they're coming inbound? Are you like finding unique niche companies and cold emailing them? Like, what's the job look like, at least in sort of more sales speak, like the top of the funnel of the job?
Yeah. We're generally not the first capital into companies we invest in. Most often, companies have raised a couple of rounds of institutional capital before we partner with them. And so, an important part of our job is building strong, productive relationships with earlier stage investors, seed investors, Series A investors, corporate VCs, things like that. And it's a mutually beneficial relationship. And so we get lots of introductions from other investors and folks like that in the ecosystem. We do a lot of sort of what I call bottoms-up thematic research. And so at any point in time, any person on our team is looking into 2 or 3 different areas of sort of thematic work and developing a point of view and a thesis. And so as part of that, we'll reach out to most or all of the companies that are building products in that category and spending time with founders to really get a good perspective. And founders are receptive to that, because if you sort of blast a cold email to a founder, they have no reason to respond. But if you have some level of insight, or you've demonstrated that you've thought about their product and their market, most oftentimes they're willing to chat. And so we do a lot of that work as well. There's LPs often have connections and will provide introductions to companies. Tons of important conferences like AWS reInvent or Money 2020 for FinTech that we attend, and we host a lot of events, founder events, things like that that we meet people at. And so it's very much that is it's a really fun part of our job, but it takes up a lot of our time and energy too.
Yeah, and I guess to follow up on that, I would ask, like, what are the if you could give an example of a really successful investment that you've made in the last 5, 6 years, whatever you've been there, and how did the conversation start before you made the investment, and how did you close with that founder?
Yeah. Maybe Dream Games is one that I was just playing their game before I got on the call with you, so it's top of mind. But Dream Games is basically it's a mobile gaming company. They have 2 titles now. The first one is called Royal Match, and then there's their second title, which they launched 2 months ago. It's called Royal Kingdom. You guys should check it out after this. But that was an example, I think, where
go download it, everyone who's listening.
Yeah, I think this is an example where just experience in the space and establishing relationships early matters. This company is actually based in Istanbul, Turkey, so it's our first ever Turkish investment. But we had the privilege of meeting Soner, the founder and CEO, before he launched the game. I think they were like a 6-person or 7-person team in Istanbul building their first game, and we had reached out and met him, and we were really impressed by his vision. And then we met him a couple of times before the game actually launched, and just talking about his thesis and his vision and sort of what he wanted the company to become. And then when how
did you find him? How did you find this person?
Well, we spent a lot of time in gaming before. We knew one of their investors who led the last round. We had done a couple of gaming investments with them. And Istanbul actually has a very strong gaming ecosystem. There have been a couple of major gaming exits in Istanbul, and so we were tracking that sort of scene as well. And so they were on our radar as like one of the really strong new teams in the market. And so, by the time they had launched their first game, Royal Match, this was in summer of 2021, it was pretty much an immediate sort of rocket ship. The game was extremely successful out of the gate and grew extremely quickly. And so I think 2 months, something like that, after the game had launched, we ended up investing in the company's Series B, and then they ended up raising a Series C just 6 months after launch because it was so successful, and we participated in the down round as well. But yeah, I mean, obviously these were competitive financings, but I think having met Sona early, having sort of really taking the time to understand him, not just the game and the metrics and the growth, but taking time to understand him and the company and the vision, and him being able to spend time with sort of us ahead of a financing, I think was really, really important. And it's been just such a privilege to see them execute so well in towards the end of 2024. It's also just funny how big gaming is and how sort of under the radar is. Their first game, Royal Match, was the number one grossing mobile game in the entire world last year.
Oh my God,
which was just
wow.
number one on the app chart on sort of the iOS App Store and Android. And it was just so cool to see that, having met them before they had anything.
It's cool how reputation in what you've invested in built the ability to meet these folks and being in the space, and then built this new investment opportunity, which is going to cascade. Like, there's a huge snowball effect, which is really cool. And also a component of focusing on good companies, investing well, and then it breeds other rewards other than just financial rewards.
It's humbling. Yeah, it's not a short-term endeavor at all, but yeah.
That's super exciting. Well, I know we had an hour scheduled, and Karthik, you sort of took a flyer on us. I messaged you. I know we have a close family connection, and I sent you a note, and you were willing to come on. And I just want to thank you so much for taking the time, because it's the beginning of the year. It's busy. Like you mentioned, you're just off pat leave, coming back to work. So it's been super awesome catching up, and we'll keep you posted. Excited to share this with the world.
Yeah, thanks for having me. Excited to see where you guys take this. This is fun.
Yeah, thank you very much.
Cheers.
All right. Bye.
All right.
See you guys.